Welcome back, guys, to Keep It Simple Part 3. Now, at the end of Part 2, we actively encouraged you guys to go and observe the charts and look at the principle that we have been showcasing from the very beginning, which is the visual effect of big money coming into and leaving the market. So what we're going to be doing in Part 3 is we're going to be showing you one last diagram, then we're going to go down to a chart and we're going to show you exactly what it is in a real data example to show you firsthand. And then in Part 4 and 5, we'll be focusing on how you can devise and create your own system based off of this principle, or even simply use it as a bias on a daily basis. So as always, guys, we really appreciate the support. If you have enjoyed the series so far, drop us a like and a comment down below. So first things first, guys, if you're joining us now here at Part 3, highly recommend you going back and looking at Part 1 and Part 2 to get a full understanding of the principle and concepts that are going to be shown in the later lessons. What is it that we're looking at? Why are we showing a big pile of money? Well, all of you guys that have watched from the beginning, you know what the answer to that is. But in short, without going into detail, we're looking at visual representations of sell side and buy side big investors within the Forex and indices space. Now, this is something that is commonly overlooked, even though most people know and fully understand that it is the money that is held by these large investors and banking systems that hold the power over the market as a whole. So using them as the key element within a system is going to be very beneficial. Now, in this video, we're going to be showing you real data representation of the principles that we've shown you in Part 1 and Part 2. We're going to dive deeper into the way the market moves and what you're actually seeing on a daily basis, which you maybe been very unaware of up until now. As always, guys, if you do enjoy this video and you have liked this series up until now, drop us a comment and a like. We really appreciate it. We're going to get our illustration out of the way, and we're going to talk about the illustration that we left off of last lesson's ending, which was 2 points of separate investments. Now, again, this can be relatively easily looked at and say, yeah, I understand. But taking it into context and applying it and actually looking for these things becomes very outlandish to a lot of people, and they don't really seem to apply it in the same principle. That's why you guys and all of the mentorship students have been applying this in a very generalized way, and it works very well. We don't need to be getting confused with our kill zones 1 minute past the hour of open and candles and all this malarkey. All you need to look for is the key elements of Big Institute. Now, of course, there is always going to be the holy grail that's given to you by some other YouTubers, but it's always going to be down to one thing. You are the defining factor in any trading system. How complex and how simple it is going to be how willing you are to let something play out, to actually persist and learn with a system. Remember, there's a two-directional bias within the market, up and down. So in theory, without a stop loss, you have a 50-50 chance of being correct, but 75 to 80% of people lose. Now, why is this? Well, we're ignoring the fact of the principle that we have shown you, and that is that when big money comes into the market, we can visually see the investments coming in. We can see these spaces arising, and more often than none, you will see the move occur, and you will not see any spaces open up until big money begins to sell positions in this case. So what we're seeing is an entry right here and a take profit right here. Now, of course, it can work the other way depending on what your overall bias is, and we covered this. But the main principle here is the large current investment is only going to be as valid as the previous investment that came before it. The principle that I just explained there may seem like a bit of a confusing concept, but it is simply this. Without Institute buying into the market and creating a space, why would we ever expect anything less to occur when they leave the market? Now, directional bias has no relevance. It's all down to the principle that you're looking at. Money comes in, leaves a gap. Money begins to leave, it leaves a gap. Like I say, this could be money coming in or out. It's irrelevant of direction, it's the principle. Now we have two pieces to our puzzle. We can begin to show the principle that we have one investment coming in and investment coming out. Now, what you will be looking for is the previous overall movement, which is going to give validation to the next, as I said a second ago. So without a gap, for example, down to tell us that orders being exited here, and a new position coming in to tell us that this investment is being added to the market, and then the same principle again, orders coming out to show us they're being taken, it doesn't hold relevance between the 2 points. You have to have the synergy of the in and out principle. So here we're seeing a gap lower, telling us that price is being driven lower. Here we're having a gap higher, telling us that orders in this case are being accumulated. And then we have another gap to tell us orders are being redistributed, confirming the probability of that deeper move. Without the accumulation and the overall up move, so the space being created for a bullish investment, we cannot validate a bearish investment. We have to have both sides of the market. Now, why is this? Well, big money moves in, big money moves out. Big money moves in, big money moves out. So let's go down to the live charts and I'll show you a real data example of this, and you'll begin to see what I mean in real world terms. Welcome guys down to the data feed. Now this is a data feed of the US dollar to the Japanese yen on the hourly time frame, so you can get a good perspective of overall time and principle here that we're going to show you. For now, you can see that we have some indicators on the left that will highlight imbalances. One is set to highlight the bearish imbalances and one is set to highlight the bullish imbalances, and it will allow us to show you the exact concept we have covered up until now. But until then, I'm going to show you the principle in which we have been talking about in terms of structure. Now, in terms of structure, we know that at each low there is a high probability that we have liquidity coming in and out. The same principle here, liquidity coming in, liquidity coming out. Now, the principle behind this is basic structural understanding, and of course we have videos on this on our YouTube, and this principle is widely known and widely used. But the overall side effect of using structure is that sometimes there can be inconsistencies in the way candlesticks are read. Sometimes the structure is created after the investment is actually given, and it gives, unfortunately, sometimes a rather delayed reaction in terms of reading and following the data. Now, this is not a dig at any forms of structural following, because I still do it myself, but it's the principle and the concept of simplicity that so many people have strayed away from. Everyone is content with adding and adding and adding and adding and adding. When it gets to a point you're adding so many factors and principles into your trading system that they actually become a hindrance. So right here, we're going to turn on this indicator and we're going to look and ultimately see where these gaps appear. And we're going to talk about the validation that I spoke about in the beginning of this video. So right here, this is the bearish indicator. We have several gaps that have appeared. Now, what I want you guys to really focus on is where these gaps appear. Now, the immediate thing for us that we can see is they only appear generally in between periods of downwards price action when this is an overall upwards trending move. So we can see again, this is a downwards moving price action. From here we also have downwards moving price action. Here we have a small downwards moving price action, but there is no bullish overall gaps created within these downwards moving periods. So this is a very key part of the simplicity and understanding of the one-to-one ratio within the market. When we see these gaps appear during a pullback, if you would, or a selling period within an overall upwards trend, there is a high probability that the first space you see created after the counter move is going to be the true investment. Now, why is this? Well, when we have a fair value gap or imbalance created within an overall upwards moving market, this is selling within a bullish move. And what does that mean? That means that the orders are being redistributed, ready to be reaccumulated. Now, what do we know about big money? We can see when they get in and when they get out. We can see through these gaps. So we know they're exiting positions right here. Generally, what does that lead us to believe they are going to do once they are out of a position where they're going to reaccumulate? So keeping in mind what we have just spoke about, we can only use counter created gap to validate true spaces being created. Instead of hunting directional bias spaces, hunt counter spaces. And when you see an area opened up after you have validated to yourself, big money is taking price down and selling orders off. So there is a high probability, if we see a trending directional move, you can follow that for a prolonged period of time. So now we're going to switch over from bearish to bullish, and I want you to take note of the same principle here. And look where the bullish gaps appear. Notice how they sit at the root of most larger moves that appear within the market here. There are no, and I mean literally no, this is an hourly chart as well, so you're looking at a couple of days worth of price action here, maybe even 4 days, 1, 2, 3, 4, 5 days nearly of price action. So by following this, you would have been consistently correct in directional bias just off of this basis. Every time you see a gap created after a counter trending gap has been created, this is your signal that big money is coming back into this bullish narrative. And consistently you will see vast movements appearing from these spaces. Now, it's all good and well looking for spaces in terms of following trend, but we have to validate them with the counter move. So we will only be interested in an imbalance that is created to the upside if we have had a bearish gap created before it. Distribution, accumulation, distribution, accumulation. Consistently following the principle that big money coming out will have a visual effect, thereby shown by our counter moves, and big money coming in will have a visual effect shown by your pro trending move. And again, you can flip this whole principle on its head in a downwards move, or even within a counter scenario. You can follow the same principle here. The first bearish gap created after consistent bullish space offers a prolonged period of selling. The same principle occurs here, a prolonged period of selling. Now, of course, this is not a system. This is just a clear principle that I'm pointing out to you guys. So now that you have a full understanding and a principle of the overall in and out of big money and the simplicity of this, I implore you to go and look on your own chart and really try and focus in on this. But for example, the same principle and method can be applied to the daily time frame. It can be applied to the 5 minute, and it can be applied to the second. So I do highly recommend going and looking at that. And in part 4, we will be moving on to a way you can consistently apply this to a chart, find trade ideas using 2 simple principles. So remember guys, if you have enjoyed part 3, hit that like button, drop us a comment down below. Have a great weekend. Enjoy the rest of your week. Until the next one, stick to your plan, stick to your risk, and trade safe.